Hi, I'm Tom Mihawk, and this is the final segment, third segment of three, in the Investment Fundamentals course. It's part of a personal finance course available here online. And this slide talks about diversification. We have already talked about risk and return. We've talked about investing time frames, volatility, types of securities, stocks, bonds, alternatives. We're going to talk about those in greater detail in later chapters. But for the rest of this investment fundamentals chapter, we're going to talk about how to invest and a few other terms that are important. So diversification is the practice of mixing asset classes in a portfolio to reduce its risk. Now, how does it work? When a portfolio is constructed of different kinds of assets, in particular ones that are not correlated, meaning if the market goes down one, they go down one, or if the market's down two, they're down two. You want to have a variety of assets that don't react to market activity, economic conditions in the same way. So if the market's down two, maybe they're up one. Or if the market's down one, maybe they're up two or only down a half. And so we want uncorrelated assets. A portfolio constructed of different kinds of assets that are uncorrelated can lower its risk as compared to holding an individual security or stock, for example, or bond. A variety of them, we call them diversification, can help lower a portfolio's volatility and provide less bad returns in bad markets and give us more predictable or less volatile returns in better markets. Now, unsystematic risk is the risk caused by company operations and decisions. I used an example before about the Apple iWatch. Is it a great product? It seems to be pretty good, but when it first came out, it didn't look so good, and it doesn't have as many sales as the iPhone. Everyone seems to own an iPhone, or many people do. Everyone owns an iPad or an iPod at one point. Unsystematic risk, company-related risk, product-related risk can be reduced by diversification. If you don't, if you think that there's opportunity in technology stocks, own Google and Microsoft and Facebook and Apple and others. And if Apple makes one poor decision, you can reduce your risk by owning all of those because others of those companies will make good decisions. Systematic risk is the risk of the system. It's the risk that investors globally will be nervous and make bad decisions, sell their stocks depressing prices. Interest rates, up or down, will affect securities. Global conflicts affect and instability impact the prices of securities. So you can't reduce systematic risk by diversification. You can reduce unsystematic risk, the risk of bad products, bad companies, poor decisions, but systematic risk you can't reduce by diversification. But diversification, again, is the process of putting together a variety of securities that are uncorrelated such that they produce a portfolio that goes down less in bad markets and has less volatility over time. Some additional important concepts. Dollar cost averaging is a method of investing a similar amount over regular time periods, say $500 a month. Securities volatility causes less shares to be purchased when prices rise and more shares to be purchased when prices fall. The net effect being a lower average cost per share. It's a very effective method of reducing the risk of investing. If you have $10,000 to invest, you could put it all in the market at one point or dollar cost average it by investing, say, $1,000 a month for 10 months. Better methods exist. Some researchers and academicians argue that if the market is generally going up over time, well, for you it would be this way, I guess. Watching the video going up like this, that it makes more sense to invest in one lump sum. But the market does go up and down. Take a look at these examples here and look at how in this area, fewer shares are purchased. Well, that was supposed to be in that area. Let's do this. Let's quickly delete that. And let's try again. In this area here at the top, here we go. We're getting less shares because they're more expensive. But here, we're getting fewer shares because they're less expensive. Fewer shares at the top when the share price is higher, more shares when the share price is lower. The benefit is right here. We get more shares on average buying this way, by buying a consistent amount over consistent time periods. And then if we had done it one time and taken our chance, in this example, 600 shares at a fixed price of $10 each versus 678 shares at $8.85 on average. Buy and hold investing is a critical thing to learn. Probably the opposite, the extreme opposite of this would be day trading, where you're buying and selling within one day. Buy and hold investing is investing with the intention of owning the investment and assets for the long term. Now, why would you do this? Well, look at the chart. If you had $10,000 invested in January 1st of 1980, and you were invested all days, and it doesn't say here when the end period was, but this example holds true whether it certainly is more true the longer the holding period, but it's true over any holding period. If you had it and owned it for all days of investing, it accumulated to be worth $708,000. If you missed the 5 best trading days of that period, it was only worth $458,000. Missed the 10 best, missed the 30 best, missed the 50 best trading days, it was only worth $62,000. The point of this is that portfolio returns are greatly impacted by just the best trading days. And buy and hold investing is a way to make sure you are owning a security, an asset, a stock, a bond, on the best trading days. The concept is kind of like if you're an index or passive investor, keep your costs as low as possible. Are there better ways to do it? Sure. Are they replicable? Can they be done consistently? Hard to tell. Many people say no, not consistently. Can you beat the market? Not many people can. Can you day trade and beat the market? Not many people can. But everybody can own prudent investments, own them for the long term, and have them excel for them for the long term. The impact of fees, all things being equal, lower fees produce higher net returns. So seek lower fees. Notice in the chart on the left how a 1% expense ratio of a fund accumulates over 30 years to $4.2 million. A 1.5% expense ratio fund accumulates to $3.6 million. 2.5 to 2.7 million. The difference between 1 and 2%, 4.2 million and 3.1 million is $1.1 million. That's the difference between retiring in a very nice place with comfort and a less very nice place and having to be much more cautious about your spending, or you're giving to grandkids, or you're pursuing your hobbies, or you're traveling, or whatever. So reducing expenses matters greatly in your investing. There is one exception, however. Notice in the chart to the right that private equity in this example produced a gross return of 19.3%, but with fees of 7%, the net return was 12.3%. By comparison, a fixed income portfolio, this is 4 bars to the right, produced a 7% return but had negligible fees. Nevertheless, the private equity portfolio, even after 7% fees, returned 12.3% net. That's better. The net return is what counts. And if you can be sure that you're going to get a 7% return in fixed income with negligible fees, and you can be sure you can get a 19.3% return with 7% fees for a net of 12, you're better off with private equity. It's just you don't always know what the fees will be, and you don't always know what the returns are going to be. So it's important. The net return is what counts most. But on average, keeping fees down produces a better net return. This is an important slide. This is a chart, a way of looking at securities that Morningstar put together, in which it graphs value, blend, and growth across the x-axis and large, medium, and small capitalizations on the y-axis. Capitalizations are the number of shares times the shares outstanding. It's a proxy for the size of a company. Large is usually 10 billion and up, medium is 1 to 10 billion, small is below 1 billion in market capitalization. The value blend and growth can be measured in lots of ways. Price equity, price in the numerator, equity in denominator. Per share is a way of measuring value and growth. Value stocks tend to have lower price earnings ratios. Value stocks tend to be companies like Procter & Gamble, General Electric, maybe these days Microsoft, although it was at one time a growth stock. Growth stocks have higher price to equity, price to earnings ratios, and they reflect the fact that people expect earnings in those companies to be higher. They pay more for the same $1 of earnings. If you think about Procter & Gamble, they make Tide and toothpaste, right? There are only so many people on the earth, so many people that need to buy toothpaste. Very steady, well-made product, but only so many people and so many teeth. On the other hand, Apple creates a new watch or maybe a new car, and the growth could be exponential. So people are willing to pay more in price per share for $1 of their earnings than for a value stock. And this is a way of describing a company. Where the gray box is a large cap growth company. Might be like today, Google might be a large cap growth company. And our last slide of the investment fundamentals chapter, and in this last third component, the investing plan. Determine how much you can set aside. Set a goal for accumulation. Using both, determining how much you can set aside and setting a goal for your accumulation. I can set aside $500 a month and I want to accumulate $15,000 by the end of the year. Using both is a great way to get started. Be aware of your time frame. If you need the money for a wedding in 2 years, law school next year, a home in 5 years, that's very different than investing for your retirement, which is 45 years away, let's say. And remember that a 0.5% difference is at the bottom here. A 0.5% return for 40 years makes a huge difference. It's very difficult to find 10% more, but not so hard to find a 0.5% more per year by doing what's in the rest of this slide. So 0.5% more per year is doable and makes a huge difference. Choose your investment possibilities and then implement. Implementing is the hardest thing. Pulling the trigger, making your choices, and then implementing is the hardest thing. Keep learning. Investment information is available everywhere, and it changes. And for example, the advent of index investing, discovered maybe in the 60s, 50s, 60s, but made much more popular in just the last 5 or 10 years. Keep learning. Listen to podcasts. Read blogs. That's where the discussions about investing are happening. Evaluate your results regularly, at least annually. If you have a lot of money invested, quarterly might be more appropriate, and adjust accordingly. If you use an advisor, stay involved. Don't delegate to the advisor and then forget it. Stay involved, oversee, ask questions, use them for their skill and expertise, but stay involved. And to my point that I made earlier, a 0.5% return is what you might find if you review your investments regularly and make adjustments. Doing this on a regular basis, getting a 0.5% more for 40 years will make a huge difference in your portfolio. It's not easy to find an extra 10% a year, but an extra 0.5% you can definitely find. Thank you for listening to this segment. This is the end of the investment fundamentals chapter. You can find me at tommihok, TOMMIHOK.com. Thanks for listening, and we'll talk to you soon.